Hello. Hello, welcome to our conversation on financial reporting. In this session, we will take few business decisions, understand those decisions, and convert those decisions into financial statements of an ongoing business or an existing business. How can you say that the business is existing? If there is an opening balance sheet, we can definitely say that this is an existing business. So these are the transactions given here for a period, let us say 1 year. There's an opening balance sheet of non-current assets, current assets, and supported by equity, non-current liabilities, and current liabilities. In order to prepare and convert these business decisions into balance sheet or into financial statement, it is not enough to just prepare the balance sheet. It is always advisable to see and prepare both income statement, cash flow statement, along with the balance sheet, because all these three financial statements are interconnected and interrelated. In this session, we are not getting into the statement of changes in the equity. So there are about half a dozen to a dozen transactions. So we'll pick up each transaction, understand the impact on the financial statement, and try to see the implications on cash, on profit, and on the equity. So the first transaction is issue of new shares, 10,000 shares at the face value. The face value of the share is 10. Face value of the share is 10. So there is a receipt, okay, and the company collects money, 10,000 into 10,000 shares into 10. And is it an income? Definitely not. This is a part of the equity, or it increases the capital. And purchase 1,000 kgs of goods at the rate of 650 on credit. Whenever you have the inventory, so you can see that inventory is already there at the rate of 600, and now inventory we are purchasing at 1,000 kgs at the rate of 650. It is always advisable to have an inventory statement or a working note with respect to the inventory. Let us see that working note. Okay, let us see that working note at the simultaneously here. So there is an opening stock of 250,000. 250,000. There is an opening stock. The price is 600 rupees per unit, which is given here. So the number of units or the quantity kgs is 417 point something. So this is the opening stock which the company is already having. And now they purchase 1,000 kgs at the rate of 650, which is 650,000, okay, and that too on credit. So what will happen? What is the effect of this transaction? The purchase of stock will increase the inventory to the extent of 650,000. The purchase of stock will increase the inventory. Is there outflow of cash? No, because it is on credit. But the creditors will increase to the extent of the purchase of stock on credit. We can see that the change in a credit because of opening creditor plus the credit purchases. The change in inventory is the opening inventory plus the current purchases. Okay, so increase in asset resulted in creation of a liability. Yeah. Now sold 60% of the stock at 950 rupees per kg. Okay, so that means we have 1,417 kilos of inventory, and we sold 60% of that, 600, 850. At what price? At 950. So the sales will be 950 into, okay, 850 into 950. Okay, sales is 807,500. Is it for cash or credit? Is not mentioned. So let us assume that this is for, cash. Okay, so therefore it's a receipt and also an income. If it would not be on cash, the debtors would have increased. Okay, so in this case there is no change in the debtors. We can see that the debtors 250 plus sales minus collection, which in this case the entire sales is on is for cash, so no change. You are also able to see the interrelationship between the balance sheet, income statement, and cash flow statement. That's more important. Now, whenever there is a sale, there has to be cost of goods sold as per the matching principle. What is the cost of goods sold of this 850? It depends on Ind AS 2. Ind AS 2 says that you can follow weighted average or first in, first out. Let us assume that because it is nothing is given, let us take weighted average cost. So what is the weighted average cost of the goods now? The weighted average is the total value of the goods available divided by the total quantity of the goods available, so 635. So the cost of goods sold is 850 into 540. So the cost of goods sold will be 540. So what is the implication of the cost of goods sold? Because of the goods sold, the inventory will reduce to the extent of the goods sold. Inventory, we can see the inventory. Inventory was 250, purchased 650, and sold 540. Okay. And then it says the plant, this is relating to this property, plant, and equipment. The plant was purchased 3 years back. The rate of depreciation is 10%. Method of depreciation is straight line method. So we need to calculate the depreciation on this, but it is on straight line. If it is on straight line, we need to find the original cost, because the depreciation in the straight line is always calculated on the original cost. But here the original cost is not given. Net cost is given. What is this net? Net is the original cost minus the accumulated depreciation. So we need to find the original cost. But there is a sufficient information here that the plant is 3 years old. The rate of depreciation is 10% SLM. So that means 30% of the plant has already been depreciated. So therefore, 560 is 70% of the original cost. We are assuming that there is no residual value, it's not given. So therefore, the original cost of the plant, okay, the original cost of the plant will be equal to, we can see that, the original cost of the plant is 560 divided by 70% is the original cost of the plant. Because there is no residual value, this is also depreciable cost. And because depreciable cost is 800,000 and the rate of depreciation is 10% is given, SLM, so therefore depreciation per year is 80,000. So depreciation will be 80,000. Okay, depreciation is 80,000. Will there be a cash outflow? The answer is no, of course, because depreciation is a non-cash item. But the value of the plant and property equipment will reduce to that extent. At this juncture, I also would like to remind you about the market value comparison. Both Ind AS 2 and the Ind AS 16 says the stock the way which we calculated here. And now the property, plant, equipment. The stock should be compared with the market value. The cost of the market value, whichever is lower, should be shown. Similarly, the asset, property, plant, equipment should go through the impairment test and compare the market value. If there is a loss, show that as an impairment loss. If the market value of the stock would have been less, then the loss on the plant stock due to market fluctuation should have been shown. But in the information here, we are not given any market value of either the stock or the plant. So we assume that the market values are same as the cost value. So there is no impairment loss at this juncture, and there is no loss due to the fluctuations in market fluctuation for the inventory. There is an intangible asset sitting on the balance sheet. We can see that. And intangible assets are amortized. Intangible assets are amortized. And amortization is given. The amount of amortization is 12,500. Is it a cash outflow? No. It's an allocation of cost. So therefore, the value of the intangible will reduce to the extent of. Similarly, here also we should go through an impairment test. But since the market values are not given, we assume that there is no impairment of intangible assets too. Now we have sold 60% of the financial assets. What are financial assets here? Shares. That means this company invested in the shares of some other companies, so 90,000. And they sold 60% of it. So the cost of the assets sold is 60% of. Okay? And this, at what price has been sold? They're sold at cost plus 50% for cash. So therefore, the value of the sales of this asset is equal to 1.50 multiply is 81,000. In other words, assets, financial asset costing 54,000, sold for 81,000, and this is for cash. So there is a cash inflow. So that means on the sale of financial asset, we made a profit of 81 minus 54. If you want, we can show the net effect of 81 minus 54. But for the time being, I'm assuming I'm showing it in a gross value. Interest on long-term borrowings, 8%, and interest on short-term borrowing is 10%. Okay, interest on long-term borrowing, 8%, and interest on short-term borrowing, 10%. So the long-term borrowings of the company is non-current liabilities into 0.08. Okay, into 0.08, 20,000. And interest on short-term borrowings is 10%. Where is the short-term borrowing? The short-term borrowings into 0.10. So therefore, this is 20,000 on long-term borrowings and 20,000 on the short-term borrowings. Okay, and yeah, we forgot this. So the interest payment. Okay, the interest payment, we will make the entire interest is equal to 25,000 we pay. Can we just see what is this 25,000? 25,000 is the interest on long-term borrowings plus interest on the short-term borrowings calculated at 10% and 8% respectively on the debts which are, and we assume that we paid the entire interest on time. There is one transaction which I forgot here, is a new equipment purchased on 1st January, 65,000. Okay, the new equipment purchase 65,500. But it's also important to observe that has been mentioned, it has not been used yet. or has not been put into use. So therefore, because it has not been put into use, will not include it under the property, plant and equipment. We'll put it as a part of the capital work in progress. Since it is a capital work in progress, we don't charge depreciation on the capital work in progress. Our depreciation is only on the property, plant, equipment. The capital work in progress means the asset have not is maybe incomplete, maybe we have not installed, or the work is still in progress. So therefore, the operations have not started using those assets. Interest on long-term borrowing done, interest on short-term borrowing done, collections from the debtors. So how much we collected? The collection from the debtors is 10%. We collected 10% of the debtors. Can we see, is there a debtor? So the collection is equal to 10% of the debtor. What is the debtor now? The debtor is 250. Okay, the debtor is 250 into what percentage of the debtor collected? 75% of the debtor collected. So what will happen to the debtors? So the debtors will reduce to the extent of the amount collected. Can you see the debtor once again? Why did the debtor change? Opening debtors plus sales minus collection minus the cash sales. Suppose if the entire sales should have been on credit, then you see the amount of the debtors sitting here. But in this example, we assume that the entire sales is for cash. Similarly, we also decided, because there's lots of cash sitting on our balance sheet with us, so therefore we also decided to make the payment to the old creditor. Payment to the old creditor 30%, right? 30% payment to the old creditor. And how much is the old creditor? 370,000. So the payment to the old creditor is 101,000, 111,000. And what will happen to the creditor? Because the creditors have been paid, now the creditors will reduce to the extent of the money paid. Can we see the change in creditor? The change in creditor was 370,000, purchased goods on credit to 650,000 and paid 111,000. So therefore, the change in the creditor is because of the payment and because of the purchase of goods on credit. Then the dividend on opening capital, but the dividend can come only after. We know that dividend is a distribution of profit. Because the dividend is a distribution of profit, it is called appropriation or below the line item. So let us find profit, then we'll handle the dividend. But before you handle the profit, examine whether all the items have been taken care of. We have taken COGS, we have taken depreciation, we have taken amortization, we have taken interest on borrowings, both short-term and long-term. However, there is one particular point here, investment. We have 15% bonds, and why not? We show that accrual principle. And it is not a violation of conservative principle, because the company has purchased bonds. So the company from where it purchased the bond is under obligation to pay this. If the company is under obligation to pay this interest, then definitely I can record it. Okay. So therefore, 15% is the interest we are expecting from these bonds. And we'll definitely get, because this is an obligation, it's a liability for the company where we invested money. Did we receive the money? Oh, you can make an assumption. Yes, we received it. Or you make an assumption that we have not received it. It's up to you. So suppose we say that we have received it, then there is a cash inflow. If you say that I have not received it, then definitely show that as a current asset. Income not received is an asset. Expense not paid is a liability. I repeat, income not received is an asset. If the entire income is received, if I say, oh, entire interest we are receiving, no interest receivables, okay? No interest receivable. So let us assume that we have received because nothing is mentioned here. So now, because we have taken care of all the items, let us find the total incomes. The total income is 903,500. 903,500. Okay, so let me put the comma so that it will be easier for us to read the numbers. Okay, it will be yes. So 903,500 is the total income. And what are the total expenses? The total expenses is COGS, depreciation, amortization, cost of the financial assets, interest on long-term borrowings, interest on short-term borrowings. So sum them up, you get 711,500. So PBT is equal to the PBT is equal to income minus expenses is 192,000 is a profit before tax. Even if not mentioned, we make an assumption that there is a 25% income tax on this profit. So the tax is equal to 25% of the PBT. And let us assume that tax has been paid, okay, because we have sufficient cash. So we pay 48,000 tax also. So PBT minus tax is PAT, which is profit after tax. If no information of the dividend would have been given, then we would have transferred the entire PAT to the reserves. Okay, so we would have transferred entire PAT to the reserve. But here there is a dividend. It has been mentioned. The company has distributed dividend. How much? But the company has distributed dividend to the extent of 45%. On what? On the opening capital. Profit, dividend is a distribution of profit, but normally calculated on the capital. So therefore it says on the opening capital, okay? So the dividend that I'm going to pay is 135,000. So what will happen to the reserves? Reserves will be opening reserve plus profit current minus the dividend is the closing reserves or closing. Let us see the formula. Opening reserve plus PAT minus the distribution of dividend is the retained earnings. So profit is taken care. Now you see that cash in hand is equal to cash available 1.24 million and minus the cash payment, which is 384,000, that is 384,500. So cash in hand is equal to 856,500. And what is this? Cash in hand is an asset. So transfer that cash in hand to the asset. So cash comes from the income cash flow statement and the profit from the profit and loss. That is why the balance sheet depends on the income statement and cash flow statement. After the income statement and cash flow statement are closed, we can close the balance sheet. No change in the capital, no change in other items, okay? No change in the investments, no change in other items. So therefore, the total of the current assets plus non-current assets, okay? Property, plant, equipment, 480, Capital work in progress, 150,000. We have seen that, okay. Then intangible assets is a decrease because of the amortization. Financial assets, we have sold financial assets. So 36,000. The inventories, lots of change happened because of the purchase and the cost of goods sold. Debtors, lots of change happened because of the purchase, sale, and the collection. Cash, we got it from the cash flow statement. No change in the inventory. So therefore, the total of asset is 2.0 million. No change in other equity. Okay. The capital has increased during the period because you issued the shares. Retained earnings has changed because of the current profit and the dividend. No change in the borrowings. We did not pay that money back. The creditors, there was a distribution payment to the creditor and also purchase on creditor. So the creditor has changed. No change in the others item. So if our assets should be equal to the equity and liabilities, right? So assets are 2.0 million, 0.5 million, which is equal to non-current liabilities, equity, and current liability. So the idea behind, or the purpose behind this exercise is to understand some business decisions and convert them into financial statement. But the focus was more on the depreciation, the COGS, and amortization. Now, it depends on us. Suppose we want to bring in the change in the market value of inventories or change in the market value of the property, plant, equipment, then of course there will be impairment losses and there will be loss in the fluctuations of, okay, for example, if I pick up the same number and then go down and we say that there is a market value of the plant is given, okay? If the market value is 460,000. What is the book value? 480,000. That's what we saw here. 480,000. 480,000 is a market book value. But if the market value would have been given, okay, in this case, the book value is 480. Market value is 460. And so there is an impairment loss. If there is an impairment loss, as per the Ind AS 16, you have to show that. So the impairment loss will be shown in the income statement immediately in that year. So as impairment loss, and the value of the plant will reduce to that extent. You can see that 560 minus depreciation minus impairment. So Ind AS 16 very clearly says that all the property, plant, equipment should go through the impairment tests. And if there is a fall in the market value, show that in the books as an impairment loss. Okay. However, if the market value is higher, so there is a revaluation gain. This is where you can see the difference in the treatment of gains and losses with respect to the inventory. Now, with respect to the property, plant, equipment and inventory. In case of inventory, whichever is lower, no gain to be recorded. But in case of property, plant, equipment, you can recognize the gain, but not in the income statement. Loss, you show that in the income statement, impairment loss. Okay, because there is no impairment loss already, so this gain will be shown on the balance sheet as a revaluation reserves. Revaluation reserve, 40,000. Now, what is the value of the plant now? The value of the plant is equal to original cost minus depreciation minus impairment, though we don't have, okay, as a formula, let us keep it impairment loss, and plus the revaluation gains. And that revaluation gain will be shown on the balance sheet as a part of the other equity or a separate line item called revaluation reserve. So the asset treatment, the measurement, particularly the measurement of assets with respect to the inventory, property, plant, equipment, and the intangible asset depends on the provisions of the respective accounting standard. But in principle, the assets are those which have the ability to generate future cash flows. So the objective of this particular exercise was to examine the impact of these decisions on the opening balance sheet. So we have the opening balance sheet. Now each and every item of the balance sheet changed because of the transaction. And this change can be seen from the income statement and the cash flow statement. Okay, so that brings us to the end of this session, and